Hello, very good morning to all, and welcome to today's Daily Dose of Market Insights. I'm Kelvin here again. Very good morning, and welcome to a brand new month of August. Today will be Thursday, the 1st of August, 2024. So before we jump straight into our Daily Dose of Market Insights, let's have a quick look at the disclaimer first. All right, leverage trading carries a high degree of risk and may not be suitable for everyone. Losses can exceed deposits. This presentation is not an offer or solicitation to buy or sell, nor financial advice or any recommendation for any investment product, as well as any forecast, prediction, or projection in this presentation is not necessarily indicative of the future or likely performance of the product. This advertisement has not been reviewed by the Monetary Authority of Singapore. Okay, so before we jump straight into today's short-term intraday technical outlook on the major cross-asset classes ranging from the major dollar pair, the major stock indices, and as well as the two key commodities market that we cover on a daily basis, which is gold XAU/USD, and as well as West Texas crude oil. Let's have a recap what has taken shape yesterday in terms of economic data release, news flow, and as well as their impact on the relevant cross-asset classes performance. So let's start with the US stock market first. So what I could see over here is that the US stock market on my screen, all four major US stock indices rallied. So this actually came in within our expectation as well, which we portray in our short-term intraday technical outlook yesterday, where we actually have a bullish bias on the Nasdaq 100 and as well as the Dow Jones Industrial Average. So what's surprisingly over here is that out of these four, that means the SPX, the Nasdaq 100, the Dow Jones, the Russell 2000, all of them rallied. The strongest performer came from the Nasdaq 100 at 3%. And the reason why Nasdaq 100 was the top performer yesterday is because prior to the start of the US session, there was a analyst upgrade from a prominent US investment bank, Morgan Stanley. So Morgan Stanley reiterate their we call it top pick, because investment banks, the particular sell side division, they frequently publish analyst reports, and NVIDIA was featured as a top pick in their basket of preferred stocks to be bullish. So that actually led NVIDIA to rally close to 13% yesterday. So at the start, there was a strong push up, and what we could see over here is that if you look at the Nasdaq 100 over, notice that at the start of the US session, it actually pushed all the way up, all thanks to NVIDIA, that is actually leading the bandwagon again and creating a positive feedback loop into the rest of other AI related team play. All right, but what's interesting over here is that we know that yesterday we also do have Fed Chair Powell press conference. So during a Fed Chair Powell press conference, so it actually came with market expectation. The Fed didn't cut rate yesterday. So during Fed Chair Powell press conference, he did mention that they actually looking at this downside risk to the labor market. All right, and so that the key thing is Powell said downside risk to Fed's labor mandate is real. So we know that the US Federal Reserve, there's two mandates. One is to keep the employment market healthy in US. That means, i.e., they do not want to, we call it, create a situation where the interest rate is too high and lead to a potential or deterioration in the labor market in the US. So right now, he did mention yesterday in the press conference that the risk to the labor market is real right now due to the current high level of interest rate, and it kind of implied indirectly that the cut could happen as soon as the next meeting. Right, so that is kind of not really very of a major surprises to the market, because those who actually follow my daily dose on a frequent basis, this has already been almost priced in by the CME Fed Watch 2, which is the interest rate futures market. And what does it impact on the US stock market yesterday was, once Powell starts to speak at once he's finished his speak at around 3 a.m. Singapore time, you realize that the market actually tumbled to a bit of profit taking. All right, so it's similar to the SPX as well. Notice the profit taking in the SPX was actually much more pronounced, right? After Powell finished his speech at around 3:30 a.m. Singapore time, okay, over here. Then if you look at the Dow Jones, okay, very similar as well. So once Powell finished his press conference, I mean, there's nothing new that the market doesn't know or the market hasn't anticipated beforehand, and we see the profit taking taking shape during the closure of the US session over here. And on top of that, we do have another news that's related to the US stock market was Meta. So actually Meta actually earnings announcement was actually released after the closure of the US stock market yesterday. So it actually reported earnings that actually broke expectation. All right, so actually they actually went up above expectation. So what we could see is that Meta actually gained 2.51% after the close of the market. So if you look at the share price of Meta yesterday, the share price. Okay, this was the after session close, so it actually rallied up by 7%. So that actually also saw Nasdaq 100. So if you look at the Nasdaq 100 in today's the futures market of the Nasdaq actually also rallied by 0.8%. All right, as we are speaking right now, then the Nasdaq 100 CFD also rallied by a similar, we call it directional magnitude as well, because of the pop-up in metal share price after the hours by 7% due to its rosy earnings announcement or earnings results that beat expectation. So later I'll cover more about the short-term intraday technical outlook on the Nasdaq 100 and where are we right now given yesterday's strong rally and also today's Asia session pop up by reinforced by metal plus 7% share price increase in the after hours trading session after the release of their earnings report. Okay. Great. So now, one more thing I want to share with you all is that this will be the heat map of the S&P 500 yesterday. So what you could see very clearly, mostly all of them, those big mega cap technology stocks or mega cap stocks are in the green yesterday. And this is what I mean by NVIDIA plus 13%, or to be precise, plus 12.81% due to that highly optimistic Morgan Stanley recommendation on NVIDIA as part of their top list of stocks to actually look at, and it create a positive feedback loop into the semiconductor space, which starts to spread up into other AI related play as well. All right, so we have Amazon gaining, then even Meta prior to the earnings announcement also managed to have a positive 2.5%, but Microsoft continues to be in the red due to the lackluster earnings result that was released a day earlier. Okay, so net overall, it's still rather a very positive intraday performance yesterday, but we know that price action do not move vertical up or down, they actually oscillate within a trend. So later I'll cover on the short-term technical outlook, where are we at this juncture from a short-term perspective. Now, another big news that took shape yesterday was Bank of Japan. So this is one thing good about Bank of Japan is that they like to at the end of every monetary policy meeting, anything that changes, they will actually come out in infographic form, very easy for us to digest. So this is the latest infographic for Bank of Japan. So Bank of Japan, they hike interest rate, short-term interest rate to 0.25%. So that is more or less within expectation. Why? Because prior to the interest rate announcement yesterday at 12 p.m. Singapore time, a day earlier on Tuesday around the US session, there was actually a kind of a breaking news leak from their local Japanese media report stating there's a high chance that BOJ will use yesterday's meeting as a platform to actually further increase short-term interest rate to be in line with their normalization of their monetary policy away from decades plus of ultra easy monetary policy. So, but what's interesting over here is that they also released their outlook yesterday. So every 3 months they'll release their latest quarterly outlook, and market participants will be focusing on the policy board members' forecast on inflationary trend. So the inflationary trend that market will tend to look at will be all items less fresh food and energy. So this is actually the targeted inflation rate that BOJ will monitor to allow them to actually more or less formulate their monetary policy. So what's interesting over here is that they didn't actually upgrade their inflation outlook for the core inflation to above 2%. So they still maintain for the fiscal year of 2024, fiscal year 2025 at 1.9% and 1.9%, and only expect it gradually to actually improve to above 2.2% at 2.1% for the fiscal year of 2026. So what is implied to us that they do not see a kind of a very strong uptick in inflationary pressure in Japan. That means, i.e., whatever interest rate hike potentially going forward will be much more on a gradual basis rather than a what I call a persistent round of interest rate hike cycle. That means not every month there will be a potential 10 or 15 basis point hike. All right, as implied by the forecast of the policy board members in their core CPI rate, which is this the rate where Bank of Japan actually target to formulate their monetary policy decision. And they also come up with this assessment on import prices. So this import prices is very concerning to them right now, because we know that the Japanese yen is very weak since the start of this year, and in fact about 4 or 3 weeks back the yen actually weakened to a 38-year low against the dollar. So given this persistent weakening of the Japanese yen because of that so-called wishy-washy monetary policy, we call it rhetoric, as dictated by the BOJ prior to yesterday's meeting, has causes a consumer's confidence or consumer spending to be lackluster. Because why? Because of imported inflation that makes things in Japan rather expensive for the local consumption. So they actually did highlight this specially mentioned here, and it was being highlighted in this infographic PDF document by putting in at a big box over here. So anything that is pretty much a large implies to us that is indirectly kind of a subconscious in the BOJ minds that they are watching it very closely. So what you could see over here is that they mentioned that upside risk to prices required attention, and it's being highlighted in red as well. That means what it means that they are pretty much concerned about imported prices, which means imported inflation, and they did highlight that the risk right now is on the upside for fiscal year 2024 and fiscal year 2025, but rather balanced going forward in fiscal year 2026. So from a medium-term perspective over here, it means that any yen weakness is pretty much undesirable in the mindset of the BOJ officials, which i.e. it means that the medium-term downtrend of the dollar yen is pretty much more on the downside rather than the upside. That means, i.e., the dollar could potentially weaken against the yen much more from a medium-term perspective. So that is all came within our expectation. If I share with you on the daily chart of the dollar yen, that means because since the breakdown of the 50-day moving average since 2 weeks ago, the trajectory on the dollar yen is more skewing towards the bearish side of the story rather than the bullish side of the story from a medium-term perspective. And that also goes in line with the current fundamental thinking of BOJ right now, latest fundamental thinking based on yesterday's BOJ guidance, all right, over here, and it's being highlighted in this box and highlighted in red. And what's interesting over here is that the JGB yield will more or less be less being manipulated by the Bank of Japan. Firstly, on the March meeting, they removed the yield curve control. That means they allow the yield of the 10-year JGB, which is a benchmark of long-term interest rate in Japan, to actually being dictated by market forces. And at that point, since right now, the market forces for JGB yield is more skewing towards the upside rather than the downside, and the JGB has slowly been inching up above 1%. And yes, even though the Japanese Bank of Japan has totally removed the yield curve control, but they are still in the market on a daily basis to actually monitor the movement of the yield of the JGB, because they do not want to see the JGB yield spiking up very high due to speculative play, and that could potentially cause a detrimental effect on the economy. Why? Because some of the small firms in Japanese are still pretty much indebted, so a spike up in the longer term end of the we call it interest rate could could actually magnify the debt burden of such Japanese firms, okay, who are still highly in debt, highly leveraged. So what they want to do over here is that they also do not want to actually put in a way that they do not want to actually go back to the ultra accommodative policy again, because that's not good for the overall Japanese economy, because at the end of the day, people will not spend, because given the fact that they know that interest rate is so low for a persistent period of time, I rather not spend and I forgo my spending, because I could spend much later and I can keep on borrowing at a low, cheap rate. So they want to remove this consumer mindset about this deflationary mindset. Firstly, by participating less and less in the JGB market. So what they do over here is that after the March removal of the yield curve control of the 10-year JGB, they are still in the market on a monthly basis to purchase a total amount of 5.7 trillion yen of JGB, both on the short end to the long end of the curve. So what they did mention yesterday, that they will actually slowly gradually reduce down to almost 50% to 2.9% trillion from April 2026 onward. And how they're going to do it? So they're going to do it on gradual monthly reduction basis. So every every month, okay, each calendar quarter. So they will actually reduce by 4 billion yen by each calendar quarter. And also gradually, when this happens, you will see a 7 to 8% decrease in the bank's JGB holding as well, which is still very, very huge at this point in time compared to the other major central banks in the world. So what we could see over here right now is that the Bank of Japan, firstly, they are also on the path of gradual quantitative tightening, no longer quantitative easing anymore. That means, i.e., from a medium-term perspective, that also could potentially supports the medium-term bearish trend of the dollar yen. That means the dollar may start to see further downside pressure against the yen from a medium-term perspective, from this fundamental, we call it a new operational model or new kind of guidance that's being given up by the Bank of Japan yesterday. All right, so later I'll talk more about the price movement of the dollar yen, where we left off yesterday. All right, when we touch on more about the technicals. Okay, so these are the things that has taken shape yesterday, and also with this, we call it rather new form of thinking of the Bank of Japan. You also lead to the dollar, the dollar yen to actually plummet to below the 200-day moving average yesterday at 151.70 and traded way below 150 level during the US session after the FOMC meeting yesterday. All right, so later I'll touch more about the short-term technical, because yesterday we are looking for that intraday mean reversion bounce. So the mean reversion bounce didn't take shape and broke below the 151.70 and plummeted all the way to the next medium-term support level. All right, later I'll touch more about that. Okay, so now this is the key news flow that was released yesterday, and one more news flow on share about is more related to the geopolitical risk tension in the Middle East, all pertaining to the ongoing conflict in Gaza between Hamas and Israel. So right now over here is that Israel yesterday do a double strike on their, we call it indirectly, on their airlines, Hamas airlines. So firstly, they actually assisted, we call it there was an airstrike that actually killed the political leader of the Hamas, and the killing actually took place in Tehran, which is Iran, the capital of Iran, which is Iran is now assisting with the way that Hamas in this ongoing conflict with Israel. So that could actually kind of change the we call it geopolitical puzzle in the Middle East, because in the last few weeks there was actually looking for peace talks brokered by various partners between Israel and Hamas, but after yesterday's Israel strike on Hamas airlines or key leaders, not on their not on other third party soil, but in fact on the soil of Hamas airline, which is Iran, in Tehran over here. So that could actually increase that geopolitical risk premium, where the potential peace talk may get delayed down the road again, kick down the can. So that potentially also support gold prices as well. So we see gold price actually rallied towards our short-term resistance yesterday at that 2,420 handle, above the 2,420 handle, close to that 2,420, 2,430 mark. Okay, later I'll talk more about the gold price. Where do we go from here in terms of a short-term intraday technical perspective? All right, so now with that, now let us now focus more our attention to the ongoing fundamentals in relation to a intermarket perspective. So more on the FX market, okay, this time around. All right, so before that, let us take a look at the 5-day rolling performance chart of the FX market, where we start to see the dollar against the other major currency from a short-term 5-day rolling perspective. Okay, so what we could see over here is that this is the potential outlier where the dollar yen actually plummeted all the way down after the break of that key short-term support, which is the 15170. So that is in the key support level. Once it break, it decelerate on the downside over here. Okay, so leaving a wide gap against the other currency. So what we could see over here is that the dollar didn't actually move much against the other currency yesterday, especially after Fed Powell press conference. All right, over here. Okay, so this was over here. Yep, yeah, this point in time. So Fed Powell press conference, he starts to speak at 2:30 a.m. Singapore time, around this area. Then all the way after that at 3 or 4 or 3:30 p.m. at the closure of the US session, almost unchanged. It goes sideways. But the only thing that's keep on plummeting downwards is the dollar yen. All right, getting weaker and weaker as we speak. And right now there's a little bounce. Later I'll touch on the dollar yen technical. But what I want to highlight over here is the dollar didn't actually move much yesterday against other major currency, the other major pair, like the dollar euro, the dollar Swiss, the dollar, even the dollar sterling. And one important new on the focus will be on the sterling pair, the dollar sterling over here, where we will start to see the Bank of England meeting today. Okay, interest rate decision at 7 p.m. Singapore time. So this Bank of England interest rate decision, what market is expecting is a 25 basis point cut. All right, so this 25 basis point cut is more or less has already been priced into the market. No big surprises. Why? Because if you look at the fundamental, the United Kingdom core inflation rate continues to actually decelerate. All right, so the latest one in June, it hovers at the 3.5%. So this 3.5% year on year, in fact, is almost the lowest level since October 2021. All right, so that's close to about what, coming close to a 2.5-year low. All right, in terms of inflationary rate or core inflation rate in United Kingdom. So that actually give a green light for the Bank of England to actually start cutting interest rates to get much later than its cousin, which is ECB, which cut much earlier, 2 months ago. Okay, and also on top of that, we start to see retail spending in UK. Okay, let me share with you consumer retail sales. Okay, so retail sales in UK also starts to turn lackluster as well. Okay, it starts to inch down over here. So given the fact that its current elevated high interest rate in in UK, pardon me, not US, UK, is actually getting a bit of we call it negative adverse impact on UK retail spending, for things are getting expensive, and in terms of the interest rate, because interest rate is high, indirectly causing consumer confidence to be lackluster, and we start to see a downside breakdown in the United Kingdom retail sales year on year, because on June it actually plummeted, it actually contract to negative 0.2%. So that should be a concern about having a high interest rate for too long in the UK. So if you look at UK over here, the interest rate, right? Let me share with you. They have been keeping this interest rate for a very long period of time. Okay, so real interest rate. Okay, so they maintain it since almost a year. Okay, almost a year. Yeah, August 2023, and this interest rate, right, is the highest level since February 2008. So that was prior to the great financial crisis, where after that they cut rate aggressively. So given this swift up in interest rate and maintain this high level to close to a year, has started to show adverse impact on the UK economy. So that's why the market more or less start to price in at least a interest rate cut for today at 25 basis point. So the next step over here is going forward, how does it impact the sterling? Okay, so right now over here is that market will be focusing on the statement itself and as well as the press conference thereafter. So if there is a forward guidance that interest rate in UK will got to come down much more gradually, that means i.e. that means there is a what I call a clear signs that BOE will actually kickstart a interest rate, we call it a cut cycle, by hinting that there are signs of weakness in the UK economy, then we will start to see a much more severe, we call it push down in the sterling dollar. But if the the monetary policy statement and as well as the press conference didn't indicate any chance of the start of an interest rate cut cycle, that means i.e. this is kind of a only a token cut, then thereafter they will remain it at 5% for a significant period of time before deciding what to do next. That means it's like a data dependent approach. Then that we will start to see not so much of a movement on the sterling dollar for today. All right, if the Bank of England has this what I call data dependent approach. But if you look at the intermarket performance, right, intermarket metrics right now that is related to the sterling dollar, we're going to share with you all. Okay, so this is the sterling dollar chart in the daily chart over here. Okay, so on the daily chart over here, ever since there is a bullish breakout of this descending trend line, okay, that I drew from the high of 7th of July. Okay, let me go back to the daily again. So that's the 7th July. We know that price action starts to reintegrate below this line here. So let's put it this in dotted line. Okay, so oops. Okay, put it dotted. Okay, so over here, this portion here of 12th of July bullish breakout is considered as a failure bullish breakout. Then thereafter, the price action starts to reintegrate back into this dotted line and traded below the 20-day moving average, so indicating short-term weakness, all right, over here for the sterling against the dollar. And if I were to actually look at this situation here, okay, let me remove this, let me put it small. Okay, this particular dark blue line here is the spread between the 2-year UK sovereign bond yield, that means the UK gilt, 2-year UK gilt, minus off the 2-year US Treasury yield. So pretty much in line of how the quotation of the sterling versus the dollar. So if you look at the spread between the 2-year UK gilt against the 2-year US Treasury yield, it's also been kind of lackluster as well, trading in a range. There's a resistance here. Okay, and at the bottom, it's also kind of being supported as well. Okay, in this range over here. Okay, but if you look at the last few days, it starts to shape a lower high. Okay, a lower high against the spread, against this yield spread between the 2-year UK gilt versus the 2-year US Treasury yield. So indicating to us that the fixed income market, the relative yield of the fixed income market is not so attractive in UK anymore versus the US, all right? Because if you look at them, put away, both of the them are showing downside pressure in yield coming down. So it seems to us that the yield on the UK side of the story is falling faster than the US side of the story. So that's a relative performance basis by this lower high that's being seen, but it's still trapped within this medium term range itself. So what it means over here, right, from an intermarket perspective, unless this support level at negative 0.58% is being taken down on the downside, then we could start to see a much more pronounced weakness on the sterling dollar, okay, going down towards to retest the 200-day moving average over here. So that's from a medium term perspective. Okay, so close to this 200-day moving average at this 1.265 level. So right now, yes, there could be some form of short-term weakness, but this short-term weakness, we got to actually pay attention for the first level at around the 1.28 figure level, around this 1.28 figure level, 1.2780 level, this range over here, which also correspond to the 50-day moving average that is, I think, still at a support level. Okay, so on a medium-term perspective, right, it's almost the very, from a daily chart, right, it's kind of being trapped right now between the 20-day moving average and the 50-day moving average. Yes, there could be some form of weakness, but the first step is we got to see whether this 50-day moving average break down to the downside or not. And that also corresponds to the support level that's being seen on the spread, the yield curve, the yield spread between the 2-year UK sovereign bond, which is the gilt, versus the 2-year US Treasury yield. That's still being supported at negative 0.58%. But in the last few days, it's showing lower high, which means that potentially there could be some form of a short-term weakness today ahead of this key risk event that is taking shape later at 7 p.m. Singapore time, which is the Bank of England monetary policy meeting. Okay, so that is the intermarket and fundamentals, today's intermarket and fundamentals that I want to share with you all in respect to the risk event that is taking shape today, which is the Bank of England meeting at 7 p.m. Singapore time. Okay, so now with that, I've covered much ground on the first two portions of the daily dose. So right now, let us now focus on the intraday technical outlook on the respective cross asset classes, starting from the FX market first. So before that, let us now expand my screen so that you guys could actually see much clearer on your end on the key levels. Okay, so now let us now focus more on the euro dollar. Okay, starting with the euro dollar first. So euro dollar, if you recall, yesterday we do have a bullish bias for a short-term push up before in yesterday's key risk event, which is the Federal Reserve FOMC meeting and as well the Fed Chair Powell press conference. So we do have a bullish bias at 1.08 figure level. So the price action, the resistance level to watch yesterday was 1.0850, almost hit. Also it hit during at the start of the US session, all right, at 9 p.m. Singapore time. Then thereafter it just plunges downwards, okay, and traded sideways. So with that, it also remained resisted at the 20-day moving average, can't break above yesterday's push up. So I'll be using 1.0850 for today as my short-term pivotal resistance level, flip to a intraday bearish bias right now. First support to watch out for will be at 1.08 figure level. For sure, it's being supported since the start of this week. All right, a breakdown below this level will see the continuation of this downtrend, minor downtrend that is in place since 17th of July to expose the next near-term support level at 1.0770. Okay, over here. Okay, which also correspond to the minor swing high, former minor swing high of 1st of July. And if I were to draw a minor descending channel linking the lower highs, which was rejected yesterday as well, push it down. Okay, what we could see is so confluence with the lower limit of this descending channel as well. Only an hourly close, a breakout of the hourly close above 1.0850 will invalidate today's intraday bearish bias on the euro dollar to see a squeeze up to expose the next near-term resistance on the intraday basis at 1.0880, followed by 1.090 level. All right, so if we do the Fibo retracement, okay, it also correspond closely to the 50% and the 61.8% at the 1.088 level. Okay, now with that on the sterling dollar, so moving on the sterling dollar. So sterling dollar traded sideways yesterday, no change, still remain below our this 1.2890 short-term pivotal resistance that we highlighted, which is also the 220-day moving average acting as a resistance level as well. So with that, we'll be still using 1.2890 as my short-term pivotal resistance for today. Still maintain that short-term intraday bearish bias on the sterling dollar. First support to watch for sure will be at the 1.2780 level. So this level is rather important on the intraday basis. Why? Because it's being defined by two different technical elements. Firstly, it's the 50-day moving average that is acting as a support level. This blue line here, dark blue line, 50, and as well this turquoise green line, which is the medium term ascending trend line that I drew from the low of 22nd of April. Okay, this year only a potential break, only an hourly close with a breakdown below 1.2780, and this breakdown could actually be reinforced by that forward guidance from Bank of England indicating that they are pretty much concerned about further weakness in the UK economy, and that could actually potentially imply the start of a much more firmer interest rate cut cycle in UK. Then that could actually see a further deceleration of the sterling dollar if we start to break down below 1.2780 to expose 1.27 figure followed by 1.2620, which is the 200-day moving average. But however, if we start to see the price action starts to pierce up above 1.2890, and that could potentially reinforced by Bank of England standing pat today, that means no interest rate cut at all, and leave the door open for a data dependent approach. Okay, then that potentially could see the sterling dollar breaking above 1.2890 for hourly close above it. Then we start to see a potential squeeze up in the short term intraday basis to expose the next near term resistance level at 1.2940 and 1.2990 level. Okay, so that's for the sterling dollar. Now moving our focus now on towards the Asia Pacific currency against the dollar. Okay, so let me see where was it right now. Okay, this is the oops. I think I got to. Okay, let me go to the Aussie dollar first. Okay, so this is the Aussie dollar. Okay, so for the Aussie dollar, no change. Yesterday, it actually whipsaw around our short-term pivotal support at the 65.30 level, but can't break above Tuesday high at 65.60 and still remains below the 200-day moving average over here. So net overall, what we have over here is that I will still view that yesterday as a noise, started of the excess. So 65.60 short-term pivotal resistance for today on the Australia dollar, still maintain that short-term intraday bearish bias. First support level to watch, no change at 64.65. Okay, below it exposes 64 figure level. So what 64 figure level? If you go to the daily chart over here, there's this gray line. So this 64 level confronts with this major trend line support, major ascending trend line support that I drew from the low of 13th of October, and as well as the medium term swing low of 18 and 19 of April this year. Okay, only an hourly close with a breakout of an hourly close above 65.60 level will invalidate today's intraday bearish bias to see a potential squeeze up towards 65.80 and potentially even 66.10 level, which is the 200-day moving average acting as a resistance, and as well as this minor descending trend line that I drew from the high of 15th of July. Okay, now let us now focus on the all interesting and important dollar yen. So what we could see over here is that dollar yen is trading in a medium term downtrend after this breakdown of the 50-day moving average on the 17th of July this year. Okay, price action came down, and yesterday initially we are looking at the 15170 level again to offer some kind of bounce, but the bounce only went up as high as 15390, didn't actually hit the 154 figure level or 155 figure level, and thereafter it's going to plunge downwards and break below the 200-day moving average. And where are we right now is actually testing the lower boundary of this major ascending channel that is in place since 17th of January 2023. Okay, 2023, yeah, it should test this level at the 14950 level. So that is the next medium-term support level that we highlight after 15170, which I showcased to you all yesterday. So right now over here, if you were to look at the MACD trend indicator, okay, let me share with you. I want to overlay the trend indicator for you guys to see. Okay, give me a minute because it's a bit slow right now. Okay, so MACD. Okay, so if you look at the MACD trend indicator, it's actually plunging downwards as well over here. So what we could see over here is that the trend, the medium-term downtrend still remains intact, i.e. there is no bearish or a bullish divergence on the histogram as well. So histogram going to shape a lower low, right? So what we could see over here is that means, i.e. going forward from a medium-term perspective, then we talk about a multi-week perspective, there could still be further potential weakness towards the next medium-term support at 14620/14460. So if you look at this level graphically, is this congestion area, this minor swing low, this swing low here, 1st of February, 11th of March, and also if we were to do the Fibo retracement of this previous major uptrend from the low of 16th of January all the way up to the previous swing high of 3rd of July, okay, it also kind of correspond to the 38% Fibo retracement, and the 50% Fibo retracement correspond to that next medium term support zone after 15950 is being taken out. Okay, so what you could see over here is that we know that price action don't actually go all the way down. In terms of technical analysis, it's no vertical down move. They actually oscillate within the price action. That's why shaping lower high and lower low. So given the fact that over here there could be a push up to form another lower high somewhere around close to the 200-day moving average, I think as a resistance again as well. So now with that, let us now go to the hourly chart to look at today's intraday technical outlook. All right, so let me pull up the dollar yen again because I don't know why it become SPX over here. Okay, dollar yen. Yeah, this is the dollar yen chart. So the dollar yen chart right now, given the fact that very interestingly there is a Fibo extension level of one time at 14830, slightly below the 14950, that confluence with the lower limit of that major ascending channel that is still supporting it. And now you see the hourly RSI starts to shape that bullish divergence. Okay, very similar to the prior bullish divergence that gave rise to the bounce before BOJ meeting yesterday. Okay, there's this minor bounce. So it could start to see another form, this kind of minor corrective mean reversion bounce against taking shape on the dollar yen. So given that it already hit the second resistance, second medium term support level at 14950, and also this positive intraday hourly technical element that has been taken shape right now on the hourly RSI, this bullish divergence, supporting a potential, another round of potential mean reversion rebound that could actually play out on the dollar yen. So using 14830 as my short-term pivotal support for today, first intraday resistance level to watch will be that 200-day moving average, which was yesterday short-term pivotal support broken down the downside, now turns into a intraday resistance at 15170. So this is the first resistance level to watch. Only a breakout above 15170 will take us to a more pronounced mean reversion rebound scenario to expose the next near-term resistance at 15380. Okay, so these are the two key levels to watch on the resistance basis on the upside for intraday basis. But however, if you start to see price action starts to come down and break down again below 14830, pardon me, a bit time to sting, 14830, if hourly close below it, then forget about this mean reversion rebound. This impulsive down move should continue within its medium term downtrend phase to expose the next intraday support level at 14640/20, 14460/144 figure level. Okay, so that's for the dollar yen, and also sum up the intraday technical outlook on the major dollar pair. So now let us now shift our focus now towards the intraday technical outlook on the major stock indices, starting with the Hong Kong 33 or the Hang Seng Index. So the Hang Seng Index yesterday, we are looking for a bullish bias. Why? Because of the break above the 200-day moving average, but it's still within a short and medium term downtrend because price action still remains below the 20-day and the 50-day moving average. So yesterday, we do have a first resistance level to watch at 17,517. So price level almost hit that level before inching downwards during today's Asia session. All right, so I'll be using 17,517. So 17,517 today for as my short-term pivotal resistance level. So if any bounce didn't surpass 17,517, 18,117. I will flip back to a short-term intraday bearish bias. First support level to watch 17,185, which is the 200-day moving average. For a breakdown below it exposes last Friday and last Thursday minor swing low that was being supported on this Tuesday at 16,970. Only an hourly close and a breakout above 17,517 level will invalidate today's intraday bearish bias to see a further counter trend or mean reversion rebound scenario unfolding to expose the next near-term resistance on the intraday basis at 17,715, followed by 17,860, which almost correspond very closely to the downward sloping 50-day moving average as well. Now, moving on will be the Nikkei 225 or the Japan 225. So Japan 225, we were neutral yesterday due to a mixed element. So price action yesterday squeezed up to the upper neutrality range and hit our next resistance level at 39,350. We also correspond to the 50-day moving average acting as a resistance, and as well as this descending trend line resistance that is in place since 11th of July, which is the all-time high. All right, so with that, I'll be using, and also right now it's also broken down below this minor trend line support that I drew from the low of 25th of July now turns into a pullback resistance, and there's some form of bearish reaction right at this level right now. Okay, let's put it in dotted red. All right, so with that, and also the RSI hasn't hit the oversold region yet at this point in time. So with that, I'll be using 38,930 level, which is today's Asia session high. Okay, high 38,930. So 38,930 also correspond very closely to this this minor descending trend line as my short-term pivotal resistance on the Japan 225, i.e. the Nikkei 225, flip to a short-term intraday bearish bias. First support level to watch on the intraday basis, 37,630, followed by 37,105, which correspond to the 200-day moving average. I think as a resistance level, as support level as well at 37,105. So I repeat, 38,930 short-term pivotal resistance level, flip to a short-term intraday bearish bias on the Japan 225. First support level to watch on the intraday basis, 37,630, followed by the next support level at 37,105, which correspond to the 200-day moving average as well. Only an hourly close back above 38,930, that means a breakout of an hourly close above 38,930 will invalidate today's intraday bearish bias to potentially see a kind of a rather choppy squeeze up scenario to retest 39,350. Above it may see extension of this minor corrective rebound towards the next resistance at 40,050, which will correspond to the 20-day moving average that is acting as a resistance level, support resistance level as well. Pardon me, resistance level at 40,050. Now, for the German 30, so the German 30 yesterday returned neutral over here. So with that, I'll be using this minor swing high area here at 18,630. Because over here, what we could have over here, we do have a higher high that's been flashed out, but the hourly RSI is showing a lower high instead. Okay, so with this negative technical element on the hourly RSI, we are indicating there's a lack of upside momentum. I will flip to a short-term intraday bearish bias within this very complex expanding wedge configuration that is depicted in purple line that is in place since the low of 14th of June. So it means i.e. potentially it could actually hover around the lower limit of this expanding wedge. So using 18,630 short-term pivotal resistance level for today, first support level to watch will be at 18,385. All right, 18,385. Only a breakdown below 18,385 may expose the expanding wedge support level, which also correspond to the minor swing low of 26th of July, acting as a next near-term support at 18,220. But however, if price action continues to see a push up and an hourly close above 18,630, then this intraday bearish bias will be invalidated to see a squeeze up to retest the minor swing high area of 12th of June at 18,770 next in first step. All right, so that's for the German 30. Now moving on will be the major US stock indices. So the major US stock indices yesterday the US was starting from the US Wall Street 30 first, the Dow Jones Industrial Average. So yesterday we do have a bullish bias. Resistance level has already been made. The second resistance at 41,250. It really hit this level. So upon hitting this level over here, what we could see is that from the low of 25th of June, in terms of Elliott wave perspective, it's been traveling a 5-wave sequence with 1 wave, 2 wave, 3 wave, 4 wave, 5. And yesterday hitting at that 41,250 also hit a 5th wave target as well by doing this projection from the start of the wave 1, project it to the end of the wave 3, push it down to the low of wave 4. It gives us around the 0.764 projection. All right. So with that, I'll be using, so after 5 wave up, there could be a potential retracement to retrace this 5 wave up move sequence from a Elliott wave perspective. So with that, given that there's a 5 wave up and hitting the resistance level at 41,250 also correspond to the 0.764 Fibo extension target, which is a 5th wave target on the upside. So with that, using 41,250 as my short-term pivotal resistance level for today. So on the US Wall Street 30, the Dow Jones Industrial Average, we will flip to a short-term intraday bearish bias for this potential retracement to play out. First support level to watch, 40,080. A breakdown below this level exposes the minor swing low of 29th of July and 30th of July at 40,480 / 40,380, which also pretty much correspond to closely to the rising 20-day moving average as well. And if we will do the Fibo retracement of this entire 5 move up, this second support 40,480 / 40,380 correspond to the golden ratio of 61.8%, right? Very closely. Okay. Only a push-up and hourly close above 41,250 will invalidate today's intraday bearish bias for this retracement to place out, to instead see the continuation of this short and medium-term uptrend phase of the US Wall Street 30 for another round of impulsive up move sequence. The next near-term resistance level to watch on the intraday basis will be at 41,400 / 500, followed by 41,800 / 900 level. Now, the Nasdaq 100. So the Nasdaq 100 also hit the resistance level, first resistance level at 19,520, and we have a previous second resistance at 19,780. So given this very short move up over here, and given the fact that right now it has already retraced close to 38% over here, so 50% is like the 19,780 level, so which also correspond to the 20-day moving average that is acting as a resistance level as well. Okay, so right now it's coming to a bunch of moving average, the 50 and the 20-day moving average that's acting as a resistance. So with that, I'll flip to a bearish bias on the Nasdaq 100 using 19,780 as my short-term pivotal resistance for today. First support level to watch, 19,230, followed by 18,975. All right, so if we do the Fibo retracement of this entire push-up from yesterday, this very strong vertical push-up, the 18,975, it corresponds to the golden ratio of 61.8%. All right, and also the hourly RSI is also back at the overbought region as well. So however, if the price action going to move up and starts to see an hourly close above 19,780, then this this what I call it intraday bearish bias will be invalidated to see the continuation of the rebound on the Nasdaq 100 to expose the next near-term resistance on the intraday basis at 19,980. Okay, that's the next. Then followed by 20,190. Okay, so that's for the technical outlook on the intraday technical outlook on the Nasdaq 100. Also covers the entire intraday technical outlook for the major stock indices. So with that, let us now move on to the major commodities, starting with gold XAU / USD. So for gold, this was the resistance level that we highlighted yesterday, 2,452, exactly hit this level, and also a impulsive up move wave 5 target as well, the standardized one at 1.618, taking from the high of wave 1, project it to the low of wave 2, this wave 1, wave 2, wave 3 exactly at the 0.618% level, and now it retraced. So potentially right now, we are still in a bullish dynamic because there's no fifth wave up yet. So there is a 1, 2, 3, 4, 5. Then after that 5th wave, we may start to see a much more deeper retracement to actually correct the entire 5 movement up. And also what we could see over here is that the RSI, yes, is overbought, but being overbought, there's no bearish divergence. Oops. Okay, there is no bearish divergence. RSI continues to shape a higher high. Okay, so indicating to us there's still another chance of a 5th wave up move up, the fifth wave up move up to complete that 5-wave sequence. So with that, the RSI now is actually has really exited from the overbought level, but this exit doesn't come with a bearish divergence, so indicating that the pullback will be rather shallow rather than a deeper retracement. So this pullback could be a wave 4. Then after that elliott wave 4, you'll see that the 5th wave on the potential upside. So usually the wave 4 will retrace the entire wave 3 at around 38% to 50%. So what we see over here is that the 38 and 50% is this graphical resistance here at 2,420 level. So 2,420 level will be my first support level to watch, but I don't want to put it as a key pivotal support level because it's a bit tight, so I'd rather use it slightly lower, which is more that has more elements confluencing it at 2,400 level. Firstly, it's a psychological level, former minor swing high of 29th of July, which is the wave 1. So if this, in terms of the elliott wave perspective, the wave 4 shouldn't surpass the high of that wave 1. Okay, it shouldn't come below this level, and also correspond to the rising 20-day moving average as well. So more elements are pointing at 2,400 level. So this will be my short-term pivotal support instead, rather than 2,421. So as long as any pullback didn't surpass below 2,400 level, we'll still maintain that potential bullish bias on gold XAU/USD for that 5th wave target to play out to complete the 5-wave sequence on the upside on a minor time frame scenario on the hourly time frame above 2,452 exposes the current all-time high area from 17th of July at 2,483 next. Only an hourly close below 2,400 level, there is a breakdown with the hourly close below 2,400 level, then it will invalidate today's intraday bullish bias to see a deeper pullback towards 2,377. Then thereafter a breakdown below it may re-expose the minor swing low of 26th of June last Friday at 2,353, which also correspond to the 50-day moving average, I think, as a support level as well. Okay, so that's for gold XAU/USD. Lastly will be West Texas crude oil. So looking at the daily chart of the West Texas crude oil over here, we see the price action yesterday do a squeeze up again, but this squeeze up managed to come close to the 80-30 medium-term pivotal resistance level, which confluence with the 50-day and the 20-day moving average that is acting as a resistance as well. So if you look at on a hourly time frame, that will actually formulate our short-term intraday technical outlook. So I'll be using this 80-30 level over here. Okay, so this is the medium-term pivot on the daily chart. So as long as this 80-30 is then surpassed on the upside, that means it did have an hourly close above 80-30. Potentially, we may see a bit of retracement or profit taking shape on the West Texas crude oil, given yesterday's swift up move. All right, over here. So near-term support level to watch on today's intraday bearish bias will be 78.43, which is yesterday's broken out of that 200-day moving average, now turns into a pullback support, and below 78.43 exposes 77.20 next. So 77.20, if we do the Fibo retracement of this entire swift move up yesterday, is close to the in between the 50% and the 61.8 Fibo retracement. All right, only an hourly close above this 80-30 level will invalidate today's intraday bearish bias to see a further swift up move again on the West Texas oil to expose the next near-term resistance level on the intraday basis at 81.80, followed by 82.70, which also correspond closely to the minor descending trend line that I drew from the 5th of July. Okay, so that sum up today's intraday technical outlook on the major cross asset classes. So before we go, let's have a quick look at the economic calendar. What are the key things to look out for other than the Bank of England we call it announcement later at 7 p.m. Singapore time today. So throughout the European session today, there's nothing much we call it interesting. Yeah, we do have one Eurozone key data to watch out for that could impact the euro dollar, which is the Eurozone unemployment rate out at 5 p.m. Singapore time, 2 hours before the 7 p.m. Bank of England interest rate decision. Okay, then thereafter we will have, this is with the press conference at 9:15 p.m. Okay, where the governor, Bank of England governor, will speak 9:15 p.m. And also now to the US session, what's important will be the ISM manufacturing PMI for the month of July out at 10 p.m. Singapore time. And also market will be closing watch on the ISM service manufacturing prices input price, so that could potentially also relate to inflationary trend in the US as well. Okay, so this is something like a cost of production for manufacturers, okay, releasing at 10 p.m. Singapore time. So this is a subcomponent of the ISM manufacturing PMI data. All right, so thereafter there will be a rather quiet US session, all right, over here, okay, other than the manufacturing PMI data that will be released at 10 p.m. Singapore time. So very quickly, let's look at the earnings calendar again to see what are the any other key earnings to look out for today on the US side of the story, especially. Okay, give me a minute. This seems to be very laggy right now. Let's put the important one. Okay, so today, after the close of the US session, will be the all-important two mega cap heavyweights as well, Apple and as well as Amazon. Both of them will be releasing their earnings results or earnings report after 4 a.m. Singapore time tomorrow, okay, which is the close of today's US session. All right, so with that, I'm Kelvin here signing off. So do have a great day ahead, and we shall speak again tomorrow. Thank you.